So, uh, you know when you're driving down the highway
Mm.
and suddenly your car starts making this, like, terrifying, grinding metallic noise.
Oh, yeah, like every single bump in the road suddenly feels like the entire chassis is just gonna, shatter.
Right. You're white-knuckling the steering wheel, just waiting for the engine to explode.
Exactly, you're just bracing for impact.
Yeah, the noise is deafening. Your anxiety is totally through the roof. But then you force yourself to look down at the dashboard, and the check engine light is completely dark.
The temperature gauge is perfectly normal, right?
Yeah, exactly. The objective data is telling you the car is totally fine, even though your ears are screaming at you to panic. And honestly, that is exactly the kind of disconnect we are exploring today.
It really is the perfect metaphor for right now.
So we're cutting through all these noisy, anxiety-inducing headlines to look at the actual hard data driving the U.S. economy. And for this deep dive, we're looking at a stack of incredibly insightful materials from financial commentator Steve Eisman.
Specifically, his recent weekly wrap insights, which are just fascinating.
Yeah, we've got deep dive analysis on the first quarter bank earnings. That's 1Q26. We're looking at geopolitical market reactions, and we've got some really sharp listener mailbag questions about the whole looming threat of artificial intelligence.
It's honestly a crazy snapshot of where we are right now. I mean, everyone seems to be predicting the next massive financial crisis, right?
Go for sure. Every headline is doomsday.
But the mechanisms that actually keep the financial system running, they're telling a completely different story.
Okay, let's unpack this. Because right now, the global economy feels exactly like that noisy car. I mean, the headlines are the grinding metal. Over the weekend, talks between the U.S. and Iran completely fell apart.
Right, which is huge.
Huge. And the U.S. didn't resume bombing, but they're currently blocking the Strait of Hormuz to put, intense economic pressure on Iran. Oil prices briefly spiked over $100 a barrel on Monday morning before retreating.
So the tension is just palpable everywhere.
Yeah. And logically, a casual observer would expect the markets to just crater on that kind of geopolitical instability.
Ooh, totally. A blockade in one of the world's most critical oil choke points. That is usually a recipe for absolute panic selling.
But here is the massive disconnect. At the end of the first quarter, the S&P was down 4% for the year, and the NASDAQ was down like 7%. Fast forward to this week, with these terrifying headlines dominating the news cycle, and both indexes have bounced back to record highs.
It's pretty wild to watch.
How does that make any sense? I mean, isn't the market just whistling past the graveyard here? It feels like the headlines are terrifying, but the market is trading on pure, unadulterated hope.
I get why it looks that way on the surface, but we really have to look at how the market actually processes information, because the stock market is essentially a giant discounting mechanism.
Meaning it's looking ahead, right?
Exactly. It doesn't trade on what is happening today. It trades on what it believes will happen 6 to 12 months from now. So it's looking past the immediate conflict and, pricing in the assumption that a settlement will be reached very soon.
Wow, so it's just completely shrugging off the current tension.
Yeah, it is. Now, whether that assumption is correct is an entirely different question, obviously. But as Eisman points out in the wrap, markets will always trade on headlines in the short term, but they revert to underlying economics in the long term.
Okay, so the market is making a massive, forward-looking geopolitical bet. But if you're listening to this and you want to know the actual ground truth health of the economy, rather than just the fickle sentiment of stock traders making bets, where do you even look?
Well, you have to look at the institutions that fund the entire system. You really have to look at the large banks, specifically the big four. So that's JP Morgan, Citi, Wells Fargo, and Bank of America.
Wait, but why look at just 4 banks to judge the whole economy? Isn't that, like, way too small of a sample size to tell us what's happening on Main Street?
You'd think so, but not when you consider their scale. I mean, these 4 institutions have massive, broad-based lending businesses that touch almost every single sector of American life.
Okay, so they're basically a mirror for the economy.
Exactly. On the consumer side, they see exactly what is happening with credit cards, auto loans, and mortgages in real time. And then on the commercial side, they are funding corporate loans, small business credit lines, commercial real estate.
Right.
They don't fund every single thing in the economy, but their footprint is so huge that their data provides a highly accurate proxy for the financial health of everyday consumers and massive corporations.
Which brings us to the great fear hanging over Wall Street right now. The fear of the credit cycle turning.
Yes, the big one.
Because for the last 17 years, basically since the great financial crisis, we have lived in an era of amazingly benign credit quality. The good times that just kept rolling, interest rates were low, defaults were super rare.
Right, it's been a very long runway.
But now everyone is terrified that the music is about to stop and massive credit losses are going to mount.
Well, if we connect this to the bigger picture, the data buried in these recent bank earnings reports tells a very different story. When these mega banks report earnings, they release reams of data.
Oh yeah, it's a ridiculous amount of spreadsheets.
Seriously. JP Morgan supplement alone is 28 pages of dense statistics. But if you want to find the truth about credit health, you look at one specific, highly regulated metric, and that's non-accruing loans.
Okay, for anyone not deep in the banking weeds, let's define that. A non-accruing loan is essentially a loan that is seriously delinquent, right?
Yeah,
I'm
exactly.
talking 90 days or more past due. It's gotten so bad that the bank legally has to stop reporting the interest from that loan as income.
Which is a big deal for their books.
Yeah, and furthermore, they are required by regulators to start setting aside reserve cash for future losses, which directly hits their quarterly profit. Well, so it's basically the ultimate red flag for a bank's balance sheet.
That is the perfect definition. If a broad credit crisis was starting, you would see these non-accruing loans spiking aggressively across both consumer and commercial sectors, both year over year and quarter over quarter.
Like we saw in 2008, right?
Exactly. We saw massive, undeniable spikes in this exact metric right before the 2008 crash. But look at the 1Q26 data. JP Morgan reported $9.6 billion in total non-accruing loans.
Wait, 9.6 billion? I mean, that sounds like a huge number in a vacuum.
It does. It really does. But you have to put it in the context of their massive balance sheet, which sits at roughly $4 trillion.
Oh, wow, okay.
Yeah, so 9.6 billion is basically a rounding error. But more importantly, that 9.6 billion is actually down 3% from the fourth quarter.
Wait, it's going down.
Yep, and the numbers at Bank of America are even more striking. They reported 5.8 billion in non-accruing loans, which is down 4% year over year, and completely flat from the previous quarter. So the underlying data is surprisingly benign.
Okay, but I have to play devil's advocate here for a second. Because everywhere you look, there is constant chatter about a K-shaped economy.
Right, the idea of the divergence.
Yeah, the idea that the wealthy, the upper arm of the K, are doing fantastically well and propping up spending, but everyday consumers, the lower arm, are getting crushed by cumulative inflation and maxed out credit cards.
That's definitely the narrative.
So if the lower arm of the K is defaulting on car loans and skipping credit card payments, isn't that a lagging indicator? Wouldn't that eventually poison the macro level data anyway? Like, are the banks just lagging indicators of a middle-class recession?
That is a very serious concern, and we definitely have to validate that K-shaped reality. It is definitely not fine for everyone on an individual level.
Right, people are definitely feeling it.
Oh, absolutely. The pain of inflation at the grocery store or the gas pump is very real, and subprime auto loan defaults are indeed rising. But to answer your question, no, the systemic data isn't just lagging.
Oh, really?
Why not? Because the banks structure their portfolios specifically to mitigate that bottom-tier risk. Even if the lower arm of the K is struggling, those specific consumer loans make up a relatively small percentage of the total massive loan book of a JP Morgan or a Bank of America.
Ah, okay, so it's just a drop in the bucket for them.
Exactly. Systemically, the robust health of the commercial sector and the prime consumer sector is vastly outweighing the struggles at the very bottom. The overall default rates are just not signaling a macro-level recession that threatens the stability of the system.
Wow, okay, so the broad traditional banking sector looks stable, even if there's pain at the bottom of that K. But let's look at the shadows,
Let's do it.
because the source material dives into a mailbag question about the sector everyone is truly terrified of right now, and that's private credit. Specifically, private credit's heavy exposure to the software industry.
Oh, yeah. This is the absolute bogeyman of the current market, and it's driven entirely by the rapid evolution of artificial intelligence.
The fear here is just fascinating. The narrative is that AI is rapidly decreasing the barriers to entry in the software world. A listener named Jacob asked a really brilliant question about this.
Yeah, it was a great point.
He basically asked, if AI makes coding so incredibly cheap and easy, like if an AI agent can write a custom CRM for a business over a weekend, won't major companies just build their own internal software instead of buying expensive recurring subscriptions from outside vendors?
Like Salesforce or, smaller SaaS startups.
Right. And if that demand collapses, All these software companies go bankrupt,
Yeah.
and the private credit firms that loan them billions of dollars just get wiped out.
It is a highly logical fear. I mean, the narrative around software companies is incredibly brutal right now because the uncertainty of what AI will actually do to their business models is so high.
Everyone's just guessing at this point.
Exactly. But again, we have to look at the data to see if this narrative is actually threatening the stability of the big banks that finance these private credit firms.
Okay, so what do the numbers say?
Well, Wells Fargo, for example, disclosed $36 billion in private credit exposure. About half of that is in business services, healthcare, and software.
Okay.
And software specifically accounts for about 17% of that total, or roughly $6 billion.
$6 billion tied up in an industry that feels like it's staring down the barrel of an AI revolution. I mean, that sounds incredibly risky.
It does, until you look at how these loans are mechanically structured, because the banks don't just hand over a blank check. Most of these private credit loans held by the banks have an equity cushion of about 40%.
Okay, wait, let me stop you there. When you say equity cushion and that the bank is senior in the capital structure, what does that actually mean if the software company goes bankrupt tomorrow?
It's all about who takes the hit first.
Right. Who is standing in line taking the losses before the bank does? Let's use an analogy. Think of an equity cushion like the down payment on a house.
Okay, yeah.
If a private equity firm buys a software company for $100 million, they might put down $40 million of their own money. The bank only loans them the remaining $60 million.
That is a perfect analogy. So if the value of that software company crashes by 30% because of AI, the bank doesn't care.
Really? They don't care at all?
Not really, because the private equity firm's $40 million down payment evaporates first. The bank's $60 million loan remains completely untouched.
Oh my God. So everyone thinks AI is the meteor and software companies are the dinosaurs, but the banks have basically built massive 40% thick underground bunkers.
Yep.
The private equity guys are the ones standing outside when the meteor hits.
Exactly. The private equity investors take the hit first. Furthermore, this risk isn't spread evenly across the banking sector.
Oh, interesting. How so?
Well, another listener, Antonio, asked about regional banks, specifically the ones tracked in the KRE ETF, which is the SPDR S&P Regional Banking ETF.
Right. The index that tracks the smaller local banks across the country.
Yeah, and the data shows they actually have very little exposure to private credit. This specific software exposure is almost entirely confined to the top 32 megabanks.
And as we just established, those megabanks are extremely well capitalized with those 40% cushions.
Exactly. So even if the meteor hits and losses start to mount, it becomes an income statement problem for these megabanks.
Meaning they just have a slightly bad quarter.
Right. They might have a bad quarter for earnings, but it is absolutely not a systemic capital problem that threatens their actual survival.
Okay, so the mega banks are insulated from these software loan blowups because of their sheer scale and structure. But that massive scale forces them to operate differently, right? Like some rely heavily on traditional lending, while others lean heavily into trading and wealth management.
And the market is treating those strategies very differently right now.
Yeah, let's look at how the market is rewarding those two very different survival strategies.
Wow.
Because not all banks had the same kind of first quarter. The sources make a really sharp distinction here.
Yeah, the divergence in their performance all comes down to a metric called Return on Tangible Common Equity, or ROTCE.
Sounds like typical Wall Street jargon.
It does, but it's simply a measure of how efficiently a bank is generating profit from the actual hard capital it holds. You know, things like cash and physical assets, ignoring intangible things like brand value.
Got it. And right now, traditional lending is apparently a very tough business for generating that return.
It is highly competitive. Banks are fighting for loans not just against each other, but against a multitude of non-bank lenders.
So they have to slash rates to win.
Exactly. When competition goes up, banks have to offer better interest rates to win the business, which shrinks their net interest margin. And that margin is just the difference between what they pay out to depositors in interest and what they take in from borrowers.
Right, the spread.
Yeah. Wells Fargo, for instance, saw a 13 basis point sequential decline in their net interest margin this quarter alone.
Now wait, 13 basis points is just 0.13%. I mean, that sounds like pocket change. Why is that such a massive hit?
Because banks are highly leveraged institutions. If you have a loan book of hundreds of billions of dollars, a 0.13% drop in your profit margin wipes out hundreds of millions of dollars straight from your bottom line.
Oh, wow. Okay, that puts it in perspective.
And traditional lending requires you to lock up massive amounts of capital. Regulators demand that for every dollar you lend out, you keep a certain percentage in the vault in case things go wrong.
Makes sense.
So because of that heavy capital requirement and the competitive pressure, lending-heavy banks like Wells Fargo and Bank of America are essentially stuck generating a 14 to 16% return on tangible common equity.
Which is decent, but compare that to the banks driven by trading and wealth management. I mean, JP Morgan hit a 23% return,
Yeah.
and Morgan Stanley produced a best-in-class 27% return.
It's a massive difference.
Why is their return so much higher? Just because of the business model.
Yeah, because wealth management is a capital-light business. If Morgan Stanley takes in $1 billion of a wealthy client's money to manage, they just charge like a 1% fee on it.
Right.
They don't have to lock up their own tangible capital in a vault to back it up. They just collect the fees. So that requires far less tangible equity, which mathematically makes their return on tangible common equity skyrocket.
Okay, here's where it gets really interesting. What does this all mean for how their stock is actually valued? Is it just that investors like the flashy trading banks more than the boring lending banks?
Oh, it is pure cold math. In the banking sector, higher returns directly equal higher valuations. We measure this using a multiple called price to tangible book value.
Yeah.
Morgan Stanley, with its capital-light wealth management arm generating a 27% return, is valued at over 3 times its tangible book value.
Wow, over 3 times.
Yes, and Goldman Sachs is an incredible case study here too. A few years ago, their return profile was weaker, heavily reliant on volatile trading, and they were valued at just 1.3 times.
So they were practically a value stock.
Basically. But as their asset management and M&A businesses stabilized and exploded, their returns improved dramatically. The market completely re-rated them. Today, they are trading near that 3 times multiple alongside JP Morgan.
That's a huge shift. And then you have Citi. The sources note that since the great financial crisis, Citi has had the absolute worst return profile of the large banks.
Yeah, it's been rough for them.
They were consistently below a 10% return, and their stock was actually trading below its book value, which basically means the market thought the bank's assets were worth more if you sold them off for parts than if you kept the bank running.
Which is a terrible place to be. But look at what is happening now under CEO Jane Fraser.
She's turning it around, right?
She is. She has been ruthlessly streamlining the bank, selling off underperforming international consumer divisions and cutting costs. And this quarter, they finally hit a 13% return on tangible common equity. Because of that structural improvement, their valuation has moved up to 1.3 times. It's still a steep discount compared to the big guys, but the math is undeniable. Improve the underlying return, and the market will improve the valuation.
Okay, so the banks are doing great. Their massive equity bunkers are protecting them from private credit risks, and the systemic default data looks completely benign. But if everything is so mathematically fine, why is the smart money still so incredibly nervous?
That's the real question.
Because another listener question from Amit brought up a completely different metric. Credit spreads in the high-yield debt market. And those spreads are actively widening.
Yeah, and this is where we transition from the math of the banks to the pure psychology of the broader market.
Okay.
To understand this, we have to define what a credit spread actually is. All fixed income products, whether it's a corporate bond or a private credit loan, are priced off the U.S. Treasury yield curve.
Because U.S. Treasuries are considered the ultimate risk-free rate. They're backed by the U.S. government.
Precisely.
Because the government can always just print more money to pay you back. So there's essentially zero risk of default.
Exactly. So any debt that is not a U.S. Treasury has to offer a higher interest rate, a higher yield, to convince an investor to take on the extra risk of lending to a private company.
Right. You need a reward for the risk.
Yes. The difference between that risky yield and the safe Treasury yield is the credit spread. When the spreads are narrow, it means investors are highly optimistic. They aren't demanding much extra yield to take on risk.
But when spreads widen, it means investors are demanding a much higher premium. They're getting scared. The wider the spread, the higher the fear. It's basically Wall Street's fear index.
What's fascinating here is the nuance of that fear. Because widening credit spreads do not necessarily mean that actual bankruptcies and losses are imminent.
Wait, really? It doesn't mean things are crashing.
No. It just means that the perception of risk has gone up. Investors read the terrifying headlines about AI destroying software companies, they look at the geopolitical tensions in the Middle East, they get spooked, and they demand higher yields to lend their money out.
But wait, fear means opportunity for someone. If spreads are widening, that means the debt being issued right now is paying out massive, lucrative yields.
Exactly. You are looking right at the mechanism of how wealth is transferred in a panic, and that is exactly why financial giants like Blackstone and Goldman Sachs have both recently raised massive $10 billion private credit funds.
Hold on, I thought everyone was terrified of private credit because of the software exposure. Why are they raising $10 billion for it?
Because they are terrified of the existing private credit. The legacy loans made 2 or 3 years ago, the ones tied up in those vulnerable software companies we discussed earlier.
Oh, I see.
But these new $10 billion funds, they have zero baggage. They have a completely clean slate. They get to step into a fearful market with widening spreads and make brand new, incredibly lucrative loans at much higher interest rates to highly vetted companies. The fear of the existing investors is creating a gold rush for the new money.
That is insane.
The panic itself creates the profit.
That is just wild. The panic prices out the old money and sets the table for the new money. Okay, we have covered a massive amount of ground today. Let's pull this all together.
Sounds good.
We started with a noisy, terrifying geopolitical landscape. We've got the U.S. blocking the Strait of Hormuz. We've got an AI revolution that is actively threatening to dismantle the entire software industry. And we have credit spreads widening as investors demand more money to take on risk.
Which means the headlines are screaming at us to pull over and abandon the car.
Exactly. But the actual engine data, the 1Q26 earnings from the massive institutions that form the bedrock of the U.S. economy, is remarkably calm. Non-accruing loans are flat or down. Banks are structurally protected by 40% equity cushions.
Yeah, and the systemic credit environment remains surprisingly benign. The check engine light is definitively off.
Which leaves you with a fascinating paradox to consider. As we just discussed, giants like Blackstone are raising billions right now specifically to capitalize on the fear and the widening spreads in private credit.
It's all about who is ready to step in.
Right. So here's a final thought to mull over as you digest all of this. Given how much money is waiting on the sidelines to buy into this panic, is the real risk in the market right now the AI bubble bursting? Or is the actual risk simply being too afraid of the noise to capitalize on the panic pricing?
It really is the age-old market question. I mean, recognizing the difference between a real mechanical failure and just a scary noise is what separates the casual observer from the strategic investor.
Definitely. Thank you for riding shotgun with us on this deep dive into the real numbers driving the narrative. Before we go, a quick note from the creators of our source material. So, to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated. Keep your eyes on the dashboard, don't let the noise panic you, and we'll catch you on the next deep dive.